Mortgage rates dominate housing headlines. Economic forecasts fill financial media. Predictions about housing cycles appear constantly. Yet those narratives often miss the variable that most directly shapes housing outcomes. Two markets can face identical economic headlines and move in completely different directions. The difference usually comes down to one structural factor: inventory. Public discussion of housing markets often focuses on macroeconomic signals. Interest rates rise or fall. Inflation data shifts. Economic sentiment changes. These developments influence expectations, but they do not always determine how housing prices behave in practice. What often matters more is how many homes are available relative to how many buyers are active in the market. Inventory quietly shapes negotiation dynamics, transaction volume, and pricing pressure across housing markets. Understanding inventory provides a clearer lens for interpreting housing conditions than headlines alone. Housing headlines are designed to capture attention. They summarize economic developments and translate them into simplified narratives about the housing market. However, headlines operate at the level of sentiment rather than market mechanics. Economic news can influence buyer confidence or seller expectations, but it does not automatically change the number of homes available or the number of qualified buyers participating in transactions. Housing markets ultimately adjust through transactions. Each transaction occurs when a buyer and seller agree on price and terms. The number of available listings relative to active buyers determines how those negotiations unfold. This means that while headlines may influence expectations, inventory determines the structural conditions under which price discovery occurs. Markets exposed to the same economic headlines can behave very differently because inventory levels determine who holds negotiating leverage. Inventory fundamentally shapes the balance of power between buyers and sellers. When available homes are scarce relative to buyer demand, sellers face little competition. Buyers must compete with each other for limited opportunities. Under these conditions, prices often hold firm and transactions occur quickly. When inventory expands and listings accumulate, the dynamic shifts. Sellers begin competing with one another for buyers' attention. Buyers gain negotiating leverage. Days on market extend, and price reductions become more common. Economists sometimes refer to this balance using the concept of months of supply. This metric estimates how long it would take to sell all existing listings at the current pace of transactions. Lower months of supply indicates tight conditions and seller leverage. Higher months of supply indicates growing competition among sellers. Inventory therefore acts as the structural variable translating supply and demand into actual negotiation outcomes. Unlike financial markets, housing inventory does not change instantly. New supply requires construction, which involves land acquisition, permitting, labor, materials, and financing. Development cycles extend over long periods. Existing homeowners also influence inventory. Listing decisions depend on personal circumstances, expectations, and financing conditions. Mortgage rate lock-in further complicates the supply response. Many homeowners hold mortgages with relatively low fixed rates. Selling a home may require replacing that financing with a higher monthly payment. As a result, some owners delay listing their homes even if market conditions change. Because both new construction and homeowner behavior evolve slowly, inventory adjusts gradually rather than immediately. This structural delay means that inventory trends often persist long enough to shape market outcomes. When inventory begins to rise, housing markets rarely experience immediate price declines. Instead, transaction volume often declines first. Buyers hesitate. Sellers test pricing expectations. Listings remain active longer. Negotiations widen. Days on market increase. Seller concessions appear. Price reductions begin gradually rather than abruptly. This sequence reflects the structural nature of housing price discovery. Because prices are negotiated property by property rather than determined through continuous trading, markets absorb imbalance through reduced activity before widespread repricing occurs. Volume becomes the early signal that supply and demand conditions are shifting. Inventory ultimately functions as a pressure gauge for housing markets. When supply remains constrained, even negative headlines may not translate into meaningful price declines. Limited options keep buyer competition elevated. Conversely, when inventory expands significantly, even stable economic conditions can produce downward pricing pressure as sellers compete for fewer buyers. Inventory therefore captures the structural balance between available homes and active demand. While economic headlines influence sentiment, inventory determines how those forces translate into negotiation dynamics and price movement. For owners, inventory influences both pricing power and liquidity. In low inventory environments, properties may sell quickly, even when economic sentiment is uncertain. In higher inventory markets, selling timelines extend and negotiation leverage shifts toward buyers. For renters and buyers, inventory affects the range of options available in the market. Greater inventory often increases negotiating flexibility and expands choice, even if macroeconomic conditions remain unchanged. For investors, monitoring inventory trends provides insight into potential price pressure and transaction conditions. Capital deployment decisions often depend more on supply dynamics than on headline narratives. For the broader market, housing markets rarely move solely because of news events. Structural changes in inventory shape the pace and direction of adjustment. Housing headlines may dominate discussion, but they do not directly determine pricing outcomes. Inventory does. The number of homes available relative to active buyers defines negotiation power, transaction speed, and price pressure. Understanding inventory provides a clearer view of housing markets than headlines alone. Subscribe for market insights. Link in description for additional analysis.